You are about to watch the last video in a series of videos on cash value life insurance. If you haven't watched the introductory video to this series, I encourage you to do that now. I will link that intro video above. It's really short, 5 minutes, but it lays the groundwork for how we're evaluating all these different forms of cash value life insurance. And today, in this last video, we are going to tackle probably the most misunderstood of the four that we're talking about, and that is whole life insurance. Now, whole life insurance can be notoriously difficult to examine and understand exactly how the policy is working, and we'll get into that a little bit later in this video. But I want to start out with all the positives, and if you'll remember, if we're talking about that risk-reward timeline as it relates to these cash value life insurance policies, we had variable universal life at the far end, most risky. Then we had indexed universal life somewhere in there, universal life somewhere in here, and all the way at this end, we have whole life insurance. So, what are the positives as it relates to whole life insurance? Well, whole life insurance contains more guarantees than any other life insurance policy that exists. And specifically, there are three guarantees that are most important. Number one, there's a premium guarantee, meaning every single year, you know exactly what you're going to have to pay in the form of premium in order to keep this policy going. So that's the first guarantee that exists. The second guarantee is a death benefit guarantee, meaning as long as you pay said premium, this death benefit will always be in force until age 100 when the policy matures. And the third guarantee is the cash value guarantee. Again, assuming you pay said premium for said death benefit, there will be cash value inside your policy guaranteed no matter what. So again, these three guarantees make whole life insurance the safest form of life insurance that exists. And as you can imagine, since it has all of these guarantees and it happens to be the safest form of life insurance, cash value life insurance, I should say, the safest form of cash value life insurance that exists, you should also expect a lower return than some of the other policies on our risk reward timeline here. So what I will tell you is I love whole life insurance as something like a CD alternative or a money market alternative or a bond alternative. The risk profile between whole life insurance and these other vehicles is relatively similar. So that's the good. Safest form of cash value life insurance that you can buy, and loaded with all of these different guarantees. A premium guarantee, you know exactly what you got to pay. A death benefit guarantee, you know exactly what your death benefit's going to be. And a cash guarantee, you know exactly what your cash is guaranteed to be no matter what. But let's go ahead and talk about some of the drawbacks as it comes to whole life insurance. So these drawbacks are really in no particular order, but I'm going to start with what I consider to be the most confusing of the drawbacks, and that is what's known as bundled fees, which is really interesting because this is the only product that exists in the cash value life insurance space where the insurance companies do not have to disclose the fees that you're paying. And what I mean by that is, generally speaking, you can kind of see what fees you are paying, but you don't know the line item fees. You don't know what all the fees in this policy are. They're kept in what I like to call a black box. The only person that actually knows what fees you're paying and what they're being used for is the actuary that built the product. Your fees are not disclosed. Not to me, not to you, not to people at the home office. The only people that can peel back the onion and see the fees that you're paying and what they're going for are the actuaries on staff that build these products. So that's comforting for some people. Some people get an annual statement. They don't see any fees, therefore they assume there are no fees. Well, in this case, ignorance is not bliss because there are fees. You just don't know what they are. So this bundled fees, I don't really like that. I like to know exactly what my fees are and what they're going towards. The next drawback that I see with whole life insurance is that your dividend rate, which is often quoted to people as something like, you get a 5 to 8% dividend, is not the actual rate of return on the policy. So let me say that again. The dividend that is declared, or the dividend that your life insurance policy pays, is not the actual rate of return. So if you have a policy that has an 8% dividend, you are not getting 8% per year. And if you don't believe me, it's really easy to do some math. All you have to do is look at your annual statement from this year versus your annual statement last year, and you're going to do something like this. Cash value of, let's say, year 8 minus premiums that you've paid in that year divided by cash value year 7. And what you're going to see is that your actual rate of return is probably something like 1 to 3% less than the actual dividend rate that was quoted to you. Now, the reason that I list this as a negative is not because the rate of return on these policies is bad. That's not what I'm saying. Don't misunderstand me. It's fine that the rate of return is less. Again, whole life insurance is on this far end of our risk-reward timeline. So I don't really care what the rate of return is. What I care about is 9 times out of 10, when someone comes to me with a whole life insurance policy, they think that they're making 5 to 8% per year, because that's how dividends work in the real world. If you have $100,000 in a particular stock and they declare an 8% dividend, you're going to expect $8,000, because that's how dividends work. If you have $100,000 in your whole life insurance policy with an 8% dividend, you are not getting $8,000. So the reason this is a negative is simply because people think they're getting a certain rate of return equal to the dividend that's declared, and that is not how whole life insurance works. There's 2 more negatives that I'm going to hit on when it comes to whole life insurance. The third one is going to be the loan provisions on the contracts, and this is often overlooked. The problem with the loan provisions on these whole life insurance policies is that most oftentimes your loan provision is actually greater than, and when I say loan provision, what I mean is the interest rate that they charge you to take money out of the contract is higher than the rate of return on the policy. And when I say IRR, I mean internal rate of return. So the rate that they charge you to take money out of your contract is typically going to be higher than the rate of return on your contract, which means as soon as you take a loan on a whole life insurance policy, you are instantly losing money because you're earning less than what they're charging you to access your money. Often overlooked, very easy to understand, but hardly ever discussed. The last negative, and really this one might be most important, and that is this. Most of the good whole life insurance policies, okay? There are good and bad whole life insurance policies out there. Most of the good whole life insurance policies are sold by captive agents, which means it's the only policy that they actually have to offer. A great example might be something like Northwestern Mutual. Northwestern Mutual agents sell Northwestern Mutual whole life insurance policies. But what if the Mass Mutual policy is better than Northwestern Mutual? Well, guess what? They still sell the Northwestern Mutual policy. So I see that as a huge problem in the whole life insurance space. And really, it's unique to whole life insurance, because when you're talking about variable universal life, index universal life, most of the people that play in that space are not captive agents. They're independent agents. They can write with any of 100 different carriers out there for your cash life insurance needs. But if you're talking about whole life insurance, there's only a handful of companies that actually do business with independent agents. And of those handful of companies that do business with independent agents, there's only a few of them that actually have a decent whole life insurance policy. Most of the good whole life insurance policies work through captive agents. And I just don't like that, because how are you supposed to know that the policy that you're getting from your captive agent is really the best policy that exists when it's the only policy that he has to offer? There's so much more that I could say about whole life insurance policies, but for the sake of this video, all I really want you to take away from this is that whole life insurance is on the least risky end of the risk-reward timeline, and so therefore it should be used for things like lazy money, CD alternatives, money market alternatives, bond alternatives, or guaranteed death benefit if you would consider yourself to be at the least risky end of the risk-reward timeline. It's not good, it's not bad, it's just doing exactly what it's set out to do, and that is slowly but surely earn a little bit of cash and give you those guarantees along the way. Guaranteed premium, guaranteed death benefit, guaranteed cash growth. I hope that this whole series was helpful. I encourage you to watch all the videos. If you get through every single one of these videos, I've got news for you. You probably understand life insurance better than most insurance agents out there selling the products. Now, that may sound scary to you, but in my opinion, it's the truth. If you have any questions, any concerns, if you want me to look at a policy that you have, I'm happy to do so. You can reach me here, matt@leveragewm.com, or go to the website, leveragewm.com/contact-us. Fill out the form and get in touch with me that way. In the comments below, I want to know what you want to see next. Do you want a product review? Do you want me to do a deep dive on a specific insurance concept or a specific type of insurance? Tell me in the comments below. If you haven't done so already, subscribe, like this video, share it with your friends. Thanks so much. This has been Matt Decker with Leverage Wealth Management, and I will talk to you soon.